Hello, traders. You got Kobesy from GuruHaven, as well as Crush the Market, my fellow guru from GuruHaven. And you're joining us this week for our rendition of a video review entitled, Tariffs and Cuts. Just giving you basically a preview of the Fed next week, and also we just had the ECB wrap up its meetings. So wanted to look at a few trade ideas to think about for the rest of the month and for the month of October. Kicking it off, I wanted to start looking at the 10-year yield daily chart. I think there's a very familiar setup here going into the next FOMC. If you look at the chart, I highlight that when the July FOMC was, as well as when this upcoming one is. Similar to the July FOMC, you can see we're back testing a trend line, the magenta trend line, which you can see is running off of the lows that were made in late June and also middle of July. Right now, we're testing that. We're also testing the high of August, which was around 18 or 1.8%. It'll be interesting to see what happens here. The 50-day moving average is also in this area. I think that will probably be chopping for the rest of the week as we consolidate, as we head into the Fed meeting next week, again, which is on Tuesday, Wednesday. And the play here, I mean, very similar to what happened last time. I think if we see the Fed cut 25 basis points, waste a bullet in my mind, you'll see a similar reaction by the bond market, knowing that there'll be more cuts to come, and basically likely see more inversion with the long end continuing to roll. So we'll be on lookout for this, and I think a very good way to play this, because it is impossible to know what the Fed is going to do. If they were to not cut and pause and surprise everyone, which is probably unlikely, you'd likely see a continued spike and see the TNX basically go back up to probably somewhere over 2% or 20 here in very short order. So something to think about and look at. I'm under the assumption they'll likely cut 25, and we'll start heading back to the 2012 26 or the 2012 and the 2016 lows around 1.4, and wouldn't be surprised if we break those, to be honest. Looking at the 10-year yield on a monthly chart, wanted to review this because this is something that we saw back in June. We were calling for a big move coming into the FOMC that we had in July, with the main indicator that I saw was basically the monthly MACD going negative. This has happened 4 times. It happened in November of 2000, November of 2007, and December of 2014. And for the second time in the last 20 years, the 13 EMA has also crossed the 50. This happened in November 07, and you can see this is highlighted on the chart with these ovals. So normally before previous downturns in the stock market or major moves in the bond market, you've generally had a bounce to back test key moving averages, and other support levels. We're definitely bouncing now. Can we get up closer to over 20 or 22 near the 13 EMA on the monthly? I think that depends if the Fed pauses or not next month. If they do, that certainly will happen. And if they don't, I think there's a good chance this continues to just roll on down. So it'll be interesting to see, what occurs. Right now, my lean is that the Fed will probably not stand strong in the face of all the rising global and political pressures. You have the ECB lowering rates, going to negative 50, cutting 10 basis points this week. And then you have Trump tweeting daily, trying to pressure the Fed. So it'd be pretty surprising if they didn't cut at least 25. And lastly, what will this mean for the actual bond chart? Obviously yields move inverse to the actual bond price. Always good to do your own research and look up why that is. Obviously, here we've seen a major move on out of the cup and handle that we had at the end of 2018. We've had one huge move up, a second huge move up, and now basically poised potentially for a third move, and it could be the largest of all. Each of the last 2 times we had a MACD cross on the daily near the center line. This is something I looked for the last time, And the bond chart, the daily TLT is pretty technical. I mean, if you can see throughout, the past 5 years, when there's divergence, either bearish or bullish, you usually get a decent trend change. We've had, bearish divergence on this most recent high, which led to the large pullback. We're pulling back near the 50 day moving average, and also the previous support around 138, 139. This is very similar to what we did after the first run up in one, where we consolidated going into two. And it launched coming right out of the Fed meeting only a day or two after, and literally did not look back. So this is something we'll be looking for. I think trading the bond market is important. If you don't trade it at all, I think it's something to think about, whether or not it's doing options and doing calls, or puts or strangle on TLT, or trading some derivatives off of it. But it's good to hedge on equities, whether or not you're short equities. You could have been long the bond market and done really well, as bonds moved even more than shorts at times on equities. And then also, you could have also been shorting the bond market recently with all the divergence on the daily and all the hourly timeframes as well, with a likely pullback coming back for the bond market, which also would inversely correlate with money likely moving into the stock market and having a relief bounce there, which is exactly what happened. And having a hedge on helped us capitalize on this recent move in TLD down, and we'll now be looking for a potential move up into this next Fed meeting. And it's also worth noting, if you're not aware, talking about bonds versus equities, the U.S. domestic bond market is estimated to be somewhere between $40 to $50 trillion versus the stock market, which is around half of that. So the bond market is generally larger, and that's why many people like to think that it is usually the one that's correct. So we'll see what it does in this next move. It's going to be really interesting to see what happens, after the Fed meeting next week. Probably one of the most important Fed meetings we've had in a while. What's also correlated with bonds, rates, and the market, also a bunch of commodities. Example, gold, and Crush is going to walk you guys through a few gold charts he has, and I think also an equity chart as well.
Hey, Kobesy. So yeah, today was a interesting day for spot gold. We had the ECB meeting today, and we got pretty much what we expected here. We got a cut in rates, just slightly further negative, and QE infinity. But I guess we later found out that it wasn't really infinity, because it's going to run out within 12 months. So we saw gold tag back up to 1521 resistance, and also hit the 10-day moving average, and then basically roll over from there. So we've now formed a lower high in this price action. So from here, I'm expecting us to see us move and retest once again the 1481 support, and that'll coincide with hitting the uptrend line there. I do expect going into the FOMC meeting that trend line will hold. Of course, if it doesn't hold in the next few days, then we could see 1432 start to happen with the price action. But I do expect it to hold, considering we've had a bit of consolidation lately. So leading into the FOMC meeting, I do actually expect to see gold creep back up higher along the trend line, potentially retesting once again 1521. But my guess is maybe we go a little bit lower than that, form another smaller lower high from there going forward. But I've written here that we're still stuck in consolidation for gold, despite the extra QE from the ECB. So the reason for this is really you need to take a look at the weekly chart to understand why we're in this consolidation mode, and why I actually expect it to continue much longer. So we've got the chart here. As you can see, after we had our multi-year sideways movement, we've broken out of that, and we basically just shot straight up all the way to 1560 area, and we didn't really have any pullback along the way, and it's only just starting to happen now. So I've got on the chart there, you can see the arrow, it's pointing to the 52-week moving average. And you can see that there's quite a big distance from where the price action is currently sitting and the 52-week moving average. So because there's so much space and we haven't had much consolidation, I'm actually expecting for at least a few weeks, potentially even a month of more sideways movement or further pullback for gold along this bull trend going forward. Looking at the weekly chart as well, if we do actually fall all the way to 1432, the bullish trend in gold would still be intact. But I don't see that. Well, it is a possibility, but I don't see that happening at this stage. But I guess we'll take it day by day with this. So I wanted to just have a look at the S&P 500 now. So if we can have a look at that, yeah. So today it's just quite amazing. We basically nearly retested old highs in the S&P 500, and as you can see, we moved up to the 3018 resistance level and then backed off from there. So we could see the next day or so a pullback back to the trend line, the short-term uptrend line that I've drawn in there. But similar to last FOMC meeting, I see us creeping forward higher and breaking out into new highs in that box area that I've drawn there. And I also do expect on the actual day of the FOMC meeting that we either will roll over on the day or within 1 to 2 trading days, the S&P 500 roll over after the strong run up leading into the FOMC meeting. And I think this is the case because even though I do expect the power 2 cut with at this stage 88% chance of a rate cut, I think his rhetoric is going to continue that the economy is strong. We don't need that much in rate cuts going forward because things are awesome, which they really aren't, but he's got to talk it up. So that's going to cause the market to throw a bit of a tantrum, I'm expecting, going forward. And we could see a bit of a rollover in the short term with the S&P 500 market.
Yeah,
So that's what I'm seeing at the moment.
I'm kind of seeing similar stuff here, Crush. I think that first off, I think 3018. I think I have that on one of my charts as a 261.8% fib level, drawing off of I believe it was the 1560 or 1570 like high from the .com, and also I think near the top of 07, 08. All the way down to that 666 bottom, and this is on equity futures. So I have, depending on how you draw it, I think it's I have one that's at 3018. I think I have another, if you draw it exactly from the high and the low, I think that goes to like 3040. So I completely agree with you. I think somewhere in this range, we'll probably be topping out. That price action to me every day is some news that is marginally good comes out overnight. Basically, you have the pajama traders taking us up. Shorts get stopped out in the morning for some price action. And then there's basically no follow through. And it's just been very slow intraday. If you're a day trader, I mean, some of the best opportunities are basically at the start of the day. And then you're basically trying to sit on your hands because there's really not much going unless a random tweet comes out. Sort of like today, where there was a confirm and then deny of some interim trade deals. So I think it'll be very interesting to see, what happens here as well. For me, I think it looks like, it'll be a major top. And I agree with your timing. The only thing that's a wild card for me is that I guess it's quad witching on Friday. Okay. So, can they stall it out? Or does Trump maybe tweet following the meeting? It would be surprising to me, given how active he is, pushing Powell, that he would not be pretty quick to respond if there was only a 25 basis point cut, which is what I think is going to happen. So this is a great chart, and I feel very similar about where we're going. Over 30, 40 or 30, 50, it would kind of start making me question what's in terms of my
Yeah,
overall kind of bearish thesis in terms of this being a major top.
yeah. It's interesting, like we're expecting a trade deal, supposedly, or talks at least, for a potential trade deal, and that's why the market's moving up. But why is it so far into the future, this meeting? Like, if we were close to getting the deal done, why they postpone it so long? That's a question that I'm thinking about. So really, it tells me that yeah, okay, we're moving up here and there with tweets and stuff on the trade deal, but I think it's more the liquidity of more rate cuts coming that's keeping this market up. You know, it's not about earnings anymore. It's not about the economy, which is getting closer to a recession. It's all about liquidity and more stimulus.
Yeah, I do think at some point the forcing stimulus, as you can see what's been going on in Japan and in Europe, and debt just hasn't been as effective, for GDP in the past decade as it was, 50 or 60 years ago. So I think that there will be kind of like a point where you realize that, oh shoot, the Fed really can't save us, and they're trying to preempt something from coming. And that's all Trump's doing in my mind, is that he's trying to preempt the inevitable and try to delay it as long as he can until the election. And you've seen through some of his tweets, I mean, he's already said, like, my stock market, and you have to count my gains from the day I got elected. If you're thinking like that, clearly you think there's a risk that you're going back to that level. So you can say, well, I didn't lose you any money. So at
Mm.
the end of the day, so it's pretty interesting to think through some of the psychology here, and what's happening. I think that meeting is scheduled for October, for good reason, because I think that it needed to be after this FOMC, so that there's basically ammo if he wants to go try to uh, attack the Fed and get his next rate cut. So,
Right,
which would
right.
be kind of silly. I think he's, in a sense, kind of treating the whole market like it's a real estate company. We know how successful he's been with that.
Yeah, I know.
Not so great on some, but anyway.
Yeah, no, it is interesting with all this going on. Really, the global, you know, economy has a too much debt problem. That's what it is, and we're not facing those problems. We're just trying to kick the can down the road, and you know, when we all go to zero, when we all go to negative, then what? You know, it's
Yeah.
just not going to work. You know.
Hopefully someone becomes sane, and hopefully it's us. I would hope the U.S. doesn't go below zero, but you never
Mm,
know.
mm.
So it's going to be really interesting to see what happens next week. So, um, and with that, we'll probably conclude our video review for today. Hope you liked the tariffs and cuts. As a quick reminder, you can always chat with Crush the Market and me, Kobesy, every day, any time of the day. If you want up on GuruHaven, just got to go to our website, www.guruhaven.com. Easy to sign up. We'll get you into our workspace, and then you can chat with us and see more of our material, and talk with us intraday, all the time. And we have a lot of fun while doing it. So hopefully we'll see you in there. And until the next video, good luck handling trading over the next week, and be very wary of FOMC next week. Enjoy, guys.